Hi, this is Dean Odell with 7 Gables Real Estate in the Odell Group, and today is August 25th. It's time for another Tustin Talks, and I'll tell you, I'm really enjoying this market because there is so much misinformation out there. People don't know what they're talking about, which is why you need to stay tuned into here and subscribe, because this is a data-driven report. This is what's really happening out there. Not all the YouTube videos out there with all the naysayers and the crazy people saying the market's going to crash and prices are going to drop 40%. So let's talk about why that is, all the misinformation, and the reality of what's happening in this market by starting with the first chart. And I'll tell you where we're going to start today a little bit differently. We're going to start with demand. That's where we're going to start. Let's talk about what normal demand is versus what demand is now. Okay? I guess to talk about normal, we should talk about what is not normal. And what is not normal was 2020, 2021. If you look at this sheet, the demand was super high in 2020 and 2021 because we were recovering from what I like to call the big C. We're not going to talk about those years. We're going to talk about what was normal. 2,816 homes in escrow is the normal number for this time. So what do we have now? 1,849. So, oh my gosh, you're going to say, well, wait a minute. Last year, the red line, we had 2,506. We're down 36% from last year. We are down, way down, almost 1,000 homes from the year before, but we are up about 10% from the previous month, from 1693, which was the low, which was when rates hit the highest point. So what is going on here? I mean, we have less people buying homes. Why is demand muted? Well, we've got interest rates going all over the place because we have to rely on the free market, and the free market is trying to figure out what is going on with this economy. Are we in a recession? Are we this, we that? We're bouncing all over the place. We jumped up at the beginning of the year from 3.25. We went all the way up to about 6.75 at its high, and now we are kind of fluctuating between 5 and 5.75. And we had a drop in rates, which kicked up our demand because our demand is definitely connected to interest rates. So we still have 1,117 homes that went into escrow below the normal, below 2017 to 2019. Let's talk about why that might be by looking at the active listing chart next. So if we look at where we are for the inventory, remember the orange line, we started with 1,000 homes towards the beginning of the year, and we are all the way up to 4,069, and that is actually great news, okay? And it appears that inventory has peaked for the year, and this is the normal time that inventory will peak. But let's talk about again, we may be on a normal pattern here, but what is the normal inventory level for this time of year? So the 3-year average prior to 2020 is 6,749 homes. So look at how many less homes we have under the norm, right? Last year we had 2,528. We are up quite a bit since then, and like I said, that's good news. Now, what is explaining what's going on in the market? Is it a good market? Is it a bad market? Well, it's as simple as supply and demand, you guys. Let's go back to basic economics here. So here's what we're going to do. We're going to take the supply, the number of homes, and we're going to divide it by the demand. And we're going to look at this year versus the past. So if we look at this year, we just said we have 4,069 homes and we have 1,849 for demand. You divide, that is 2.2 homes that are for sale for every home that's going in escrow. So now let's go back to the normal years prior to 2020. 6,749 homes on the market, 2,816 in escrow. We divide, we get 2.39 homes per buyer. So in the past, every buyer had 2.3 homes to choose from. Now, every buyer has 2.2 homes to choose from. Which do you think is the better market for the seller? So all this garbage that people are spouting and saying the market's crashing, things are bad, no. But I'll tell you what really is important is pricing, and we'll talk more about that later. But let's talk about where are the listings? Why are we short so many listings? And I'm going to tell you right now. First of all, the normal amount of homes that would have listed between January and July is already down 4,373 homes for the year. That's how many more homes should have already listed to be in line with the norm. The homes that are being pulled off the market because people are putting their houses on the market still trying to get higher prices than what the highs have been, those homes are up 127%, meaning they're being pulled off the market. They're not selling. So those houses are going away. Another reason, and the last reason why people aren't moving. 72% of the people have mortgages at 4% or lower. 55% of the people have mortgages at 3.5% or lower. And 34% of the people have mortgages at 3% or lower. So why don't you think people are moving? It's not that they're in love with their homes, they're in love with their mortgages. The mortgages are keeping people in their houses. But think about it. For most of these people, if they go out and get a mortgage now, whatever they owe on their house, let's say they owe $500,000. Well, that first $500,000 is now going to be at probably 2% higher than what their mortgage is, okay? That's another $10,000 a year in interest. And most people are usually moving up in price range, so now they got a higher tax bill on top of that. So the cost of moving up has certainly changed. It's certainly stifled people from putting their houses on the market because of the higher rates. So that's what's happening, you guys. You have muted demand and muted supply, which means that the market, it's starting to go back to a normal feel in terms of speed of the market because people aren't just jumping on things anymore because there's not as many buyers competing for properties. So let's look at expected marketing time. Now, again, we don't look at 2020, 2021. Those were abnormal years. We had things selling in 22 days. Where is the norm? Well, the norm is right around 79 days, okay? Where were we 4 weeks ago? We were at 72. Where were we 2 weeks ago? We were at 67. Where are we now? We are at 65, meaning the market's actually getting a little bit better over the last month, despite all these things that you're hearing out there. Okay, so let's look at expected marketing time by price range real quick here. This is an interesting chart. If you look at the top numbers, we're at 47 days. If you look at the bottom numbers, we're at 225 days. Well, guess what? We have a hot seller's market under 750, and we have a hot buyer's market basically over 4 million. So it really is important what price range and what price point you are. So take a look at this chart. You might want to pause this for a minute and take a look where you guys are on this chart. So now let's talk about where this market is going, and we'll tell you some stories from this week. Okay guys, so another 2 weeks has gone by, and again, the market has not collapsed, okay? Now, I don't want you guys to think I'm a cheerleader for the market. I'm a cheerleader for data, you guys. I look at what the data is showing. I listen to our team. I listen to myself, what we're experiencing in the marketplace, boots on the ground. So let me just tell you, this last week, we were involved in a deal that was in the high $3 million range and had 6 offers on it after 1 week on the market and went for way above asking price, like $400,000 above asking price. So you know what? There's still a lot of activity going on. There's still people willing to buy, but guess what? Nobody wants to overpay for anything. It's all about pricing it right to make the buyers feel comfortable that are willing to buy. And we know there's less buyers willing to buy right now, but guess what? There's less inventory for them to choose from. So in the end, it feels a lot like a normal market, you guys. It is not collapsing yet. Is it going to collapse? I don't know. I mean, the recession, we're not seeing people lose jobs, and I've said it in past Tustin Talks. When that starts happening, all bets are off, right? When everybody starts losing their jobs, then we know we're in trouble. But right now, people have work. The market was built on a strong foundation. This is not the Great Recession. This is not the savings and loan crisis. The last 4 out of 6 recessions, the real estate market has fared well. And what do we have? Solid loans, good lending. I'm just not seeing it yet, you guys. I'm not seeing it. And believe me, I have kids in their late 20s, early 30s, and I would love for prices to go down for them to be able to buy. So, I don't want you guys to think I'm telling you buyers, hey, it's just going to keep going up. It's going to keep going up. But right now, we got to look at the data. And the data tells us we're still in a pretty good market. So we'll see you on the next Tustin Talks. Until then, thanks for tuning in, and please subscribe. Talk to you soon. Bye-bye.